Hi guys, my name is Andrei and welcome to my channel on personal finance. Today I would like to talk about required minimum distributions or RMDs. Besides answering the question of what RMD is, I want to dig a little bit deeper. There was a study done by JPMorgan Chase published several years ago. They found that 84% of retirees preferred to take out only their required minimum distributions. In other words, they preferred delaying their retirement account withdrawals for later. I want to understand the reasons behind such staggering statistics. Thus, I explore issues that may affect your decision whether to withdraw more than your RMD. Among things I discuss are income-related monthly adjustment amount or IRMAA, assisted living needs, and qualified charitable distributions. First, let's understand what RMD is. Once you reach the age of 73, the law requires individuals to withdraw a certain minimum amount of money from retirement accounts. These minimum withdrawals are RMDs based on life expectancy tables. The RMD minimum age goes up to 75 in 2033. So it doesn't matter whether you need RMD funds or not. RMDs are there to ensure that people pay taxes on retirement accounts before they depart. The minimum distribution rules apply to owners and their beneficiaries for these types of plans. As we see, the RMD rules do not apply to Roth IRAs while the owner is still alive. But RMDs become a must for beneficiaries of Roth IRA accounts upon the death of the owner. The deadline for taking RMDs is December 31st each year. But the first year when you turn 73, you have an option to delay it until the next year, until April 1st. So, for instance, if I say turned 73 in February of 2024, I can make my RMD withdrawal by the end of 2024, or I can make my withdrawal next year until April 1st of 2025. But keep in mind that you will have to make 2 RMD withdrawals in 2025 in that case, which could put you in a higher tax bracket. Calculating required minimum distributions is not difficult. There are many online calculators that will do the job for you. But in case you still want to do that manually, here's how I would do it. I will use the IRS RMD worksheet. First, suppose that I have several retirement accounts subject to RMDs. These could be IRAs or 401ks. I would calculate my RMD for each account separately. RMDs are based on retirement account balances on December 31st of the prior year. For instance, it's 2024. And imagine that I had $100,000 in my IRA account on December 31st of 2023. The first step is to take into account filing status and my spouse age. There are different tables depending on that. Let's suppose that there is an age difference below 10 years between me and my wife. Next is my age on my birthday in 2024. Suppose it's 75. Then I go to table 3 and see that the distribution age factor is 24.6. Then divide $100,000 by the factor of 24.6 to arrive at $4,065 RMD for this particular IRA. I would repeat these steps for all other retirement accounts subject to RMD. Once you calculate RMDs for all your retirement accounts, there's a common question. Can you withdraw your required amounts from only one account? And the answer depends on the type of account in question. For IRAs, you must calculate RMD for each account separately, but you can withdraw the total RMD from one or any combination of IRA accounts. The same thing applies to 403(b) plans. As for 401k plans, RMDs must be calculated and taken out separately for each account. If you withdraw more than your RMD in a given year, the excess unfortunately does not carry over to the next year. But what if you fail to withdraw your RMD? There is a 25% penalty tax. For instance, if my RMD was $50,000, but I withdrew only $40,000 in a given year, then I will be paying 25% on the shortfall of $10,000 or $2,500 in penalty. Also, if you can correct your shortfall in RMDs within 2 years, you can potentially reduce this penalty to 10%. Another common question among retirees is this: Am I required to take RMDs even though I continue working? And the answer is a qualified yes. Working past the age of 73 does not remove RMD requirements. But there is a waiver for your current workplace savings plans, such as 401ks, 403b, or small business accounts. There are 3 conditions to satisfy though. They are: first, you are still working. Second, you don't own more than 5% of the business you work for. And third, the business you work for sponsored your retirement account. If you satisfy these terms and your plan has no RMD requirements, then you can delay withdrawals until you stop working. Just keep in mind that delaying RMDs while working does not apply to IRAs. It only applies to the above-mentioned workplace retirement accounts. RMDs are taxed as ordinary income for federal and state purposes. So what if you're someone as a low-income individual with little assets outside of your retirement accounts? Well, in that case, RMD taxation is probably of little concern to you, since you will be probably withdrawing more than your RMDs from your retirement accounts to keep up with your spending. However, there are many people in retirement that choose to withdraw only their RMDs. JPMorgan Chase conducted a study by tracking 31,000 people retiring from 2013 to 2018. 84% of them chose to withdraw their bare minimum RMDs and not a cent more. There was a Smart Asset article suggesting that 84% of these retirees may be making a mistake, meaning failing to withdraw more than RMDs, retirees may have too much money left at the end. Of course, this could be a risk for wealthy households. But still, why do so many people choose to withdraw only RMDs? There could be several explanations for that. The first likely one is that many people have assets and income outside of their retirement accounts, and they would like to preserve their retirement account capital for later use in case of emergencies. For instance, assisted living needs become very important and sometimes very expensive consideration. So many retirees choose to use their IRA accounts as a backup in case they need to fund their senior care expenses. The second consideration has to do with the so-called Income-Related Monthly Adjustment Amount, or IRMAA. It is applicable for high-income Medicare beneficiaries and deserves a separate video I will make shortly. But here's a summary of an issue. If you are on Medicare, you pay a monthly premium. Medicare plans have many parts, but Part B and Part D stand out. Part B covers doctor's services, while Part D takes care of drug prescriptions. The standard Medicare cost split is this: retirees pay 25% of the Medicare cost, while the government covers the remaining 75%. This 25-75 split applies to individuals with a modified adjusted gross income of $106,000 or less in 2025. The threshold for couples is double that, or $212,000. MAGI is your adjusted gross income plus tax-exempt investment income from 2 years ago. That's right, 2 years ago. So in 2024, you will use your 2022 MAGI to test for the IRMAA. Here's a problem. As soon as you cross an MAGI threshold by even $1, your monthly premium jumps. It's not a tax, but kind of it is in disguise. Here's a table with Medicare Part B monthly premiums. We see that crossing the first threshold results in a $74 monthly premium jump per person. For 2 people, it's an extra $1,776 a year. It may not be much if you're earning over $100,000 per person, but still. The jumps are even more discrete and pronounced after the second and third brackets. Here's a graph for Part B premiums as a function of MAGI. As expected, it looks like a step function. Similar brackets apply to Medicare Part D premiums, but they're somewhat smaller compared to Part B. So we see that it makes sense to manage your annual income and not get pushed into a higher tax bracket if you can. And that way you can avoid tripping IRMAA thresholds and end up paying more for Medicare. Another tool that can help you manage RMD's taxation is charitable contributions. If you're over 70.5 years of age, you can donate up to $105,000 per person to one or more charities directly from your IRA. These are so-called qualified charitable distributions, or QCD. They will count towards your required minimum distributions, but QCD are tax-free and do not count towards your taxable income. I personally would not donate money just to avoid tripping tax bracket thresholds. Yes, you don't pay taxes on QCD withdrawals, but you no longer have that money if you do that. The charity does. So if I were planning to make donations anyways, then in that case QCD could be a valuable tool to manage your RMDs and avoid tax deductions phase-outs. Finally, there's one other thing that many retirees regret not doing before hitting their RMD age of 73, and that is to make Roth IRA conversions of their retirement accounts sooner. Roth IRA conversions allow individuals to convert their IRAs. Yes, you have to pay taxes on Roth IRA conversions. But if you expect to be in a higher tax bracket in retirement, then these conversions may make sense. That way you can reduce your IRA account balances and consequently your future RMDs. So as we see, there could be many reasons why retirees choose to withdraw only RMD. Desire not to overshoot and preserve capital for future emergencies is a big consideration. Also, managing tax brackets could be an important consideration for high-income households too. And that'll be it for this video. Please give it a like and share it if you think it can help someone nearing a retirement. Also, subscribe to my channel for more actionable content on personal finance. As always, thank you so much for watching and I will see you next time. All the best!